A warm welcome to the Monday on the Tape podcast. I'm Guy Adami, always joined by Elizabeth Young Thomas, she of SoFi. EY, how are you?
I am fantastic. How are you both?
That's EYT. And of course, Danny Moses drops in from time to time. It's always a pleasure to have Danny join us. Danny, how are you?
I'm doing great. Happy Monday, people.
Yeah, well, and happy Veterans Day, if I can say happy. And, you hear it from everybody, but we would be remiss if we didn't mention it as well. Thank you all who served. Thank you for your service. So here we are, Danny Moses, on this Monday, November 11th. So the election's in the rearview mirror. And the first thing that I look at, because I know this incoming administration is going to look at it, is China's trade surplus. So it's near a record $1 trillion trade surplus. Now, means a lot of different things, but my instincts suggest on the surface, the incoming administration will see this and they'll be exercised by it because, of course, they have a surplus and we don't. So thoughts on that as we get going?
Yeah, so obviously they are exporting more than they're importing, and their own markets are weak in terms of demand, and they export everything, and they flood the markets with their products. And it's basically every country they have a surplus with, but the biggest one is obviously with us. And so there's repercussions to that because they have the ability to devalue their currency potentially at any point and exacerbate that and make it even worse. So it is an issue. And one other thing that got lost kind of in the news cycle here has been the Salt Typhoon cyber attack, which is going to start rearing its head again. What does that mean? U.S. diplomats believe that China came in and infiltrated our router system via Cisco potentially, and they've been getting all this information on our defense stuff, and every politician's been targeted. We know that already. So something else to keep in the back of your mind, I think, from a things getting heated up perspective, because you're going to hear more about this Salt Typhoon guy.
No doubt. And Elizabeth, I see this and, I can just imagine what's going on behind closed doors. Again, whether there's justification for it or not, whether or not the math works, whether or not it's an equal, equitable type of relationship we have with the Chinese, people will see that and say we're getting ripped off. So I only bring it up because I think when I see that number, there's going to be a renewed or a higher, I think, volume in terms of the trade tariffs with China and how we are getting ripped off, whether we are or not.
Yeah, I mean, first of all, I think just this report in and of itself is like target practice on trade for the incoming administration. What are all the different things that we can target? What can we go after? And more proof that we need to do something about it. I'm saying this from their perspective. I think that's probably the narrative that's going to come out. So far, what's been threatened or what's been floated is up to 60% tariffs. I think it would be difficult to really actually implement that. And I think everybody understands that that would be inflationary pretty quickly to our economy. To Danny's point, though, and I said this last week on CNBC, it was a risky thing to say and a gutsy thing to say. But to Danny's point, they have control over their currency more so than we have control over ours. They have control over their economy more so than we have control over ours. And we cannot underestimate their ability and willingness to stimulate, to devalue their currency. And also, we can't underestimate the fact that they're backed into a corner right now because their own economy is weak. So there may be a situation where, yes, I think the volatility of this heats up. The rhetoric around it heats up. There's going to be all kinds of threats thrown in either direction, and that could go on for months. But they may have to do some negotiating at some point in order to settle out so that their economy doesn't get too unduly punished.
Yeah, it's interesting because, and don't at me if I'm off, but I think it was August of 2015, Danny, when we first heard in earnest that the Chinese were devaluing their currency. And by February of the following year, you saw a pretty significant sell-off in global equities. Now, I'm not suggesting we're on the precipice of that, but to both your points, Danny, that has consequences. The China deval absolutely has consequences on a global scale.
Yeah, there's economic warfare and then there's real warfare, and you can exact pain by doing both. And so they're in a position, obviously, what's going on with Taiwan, kind of daring us to come to the rescue of Taiwan if they were to do something. So there's a lot at play here. I think from Liz's point about devaluing their currency that I kind of mentioned here a few minutes ago, that is financial warfare, right? They could potentially do something there. So you have countries like India, which are obviously concerned as well, because if the rupee, if they continue to devalue against their currency, that hurts them also. So there's lots of ramifications here globally, and it has ramifications for, both stock prices, commodity prices, and everything else. So certainly something to keep an eye on.
What do you think this does for the gold trade? I mean, we've talked about gold so much, and I'm sure you have thoughts on this. If now we shift our attention from, let's say, off of the Japanese yen and onto the Chinese currency, what happens to gold here, knowing that the Chinese central bank has been the biggest buyer of gold in recent months?
I think that's a great question. I appreciate you asking me that. I think one of the reasons they've been buying it in the manner they've been doing over the last 3 years is in anticipation of probably what we're seeing. And I'm not suggesting there's some great soothsayers there, but I do think they play the long game. And I think they sort of realized some of the things they were looking at. And I think they looked across the globe and realized that central banks are sort of running amok, and they're going to take steps to sort of combat that and get in front of it. So quite frankly, I think their buying of gold sort of gives them the flexibility to do exactly what both you and Danny are talking about. And to answer your question specifically, I think that just gives more credence to the trade itself. So one of the main reasons you can't really run too far away from this gold trade, regardless of whether or not you have these down days like we saw post-election day when gold had that huge downdraft. We saw the same thing on August 5th. So when you see risk-off situations across a swath of things, gold is not sort of insulated from that. And sometimes when you see allocations of funds into equities, sometimes it's going to come out of the commodity market, specifically the gold trade. But in my opinion, I think both those times have been somewhat short-sighted, although I understand it. And I think it just lends itself to exactly what all three of us have been talking about, Danny, for the last few years.
One other thing is that Bitcoin's now up to 1.6 trillion.
Let's talk about that.
Well, crypto's about 3 trillion. If you try to assess the gold market, you'll get a number between 17 and 18 trillion. So I think part of the sell-off in gold also has to do with money being allocated or reallocated maybe from gold into crypto, believing that it's on much more stable footing now. I mean, Dogecoin's at 42 billion at this point. So you're seeing a lot of the shit coins rally as well. So I think that crypto continues to steal on the margin a little bit of gold's thunder.
Well, let's talk about crypto, Elizabeth, because I mean, a lot of this has been predicated. There are a number of different things going on, but I think this latest run is all in the back of what appears to be now a Republican sweep of the House, the Senate, and obviously the presidential election as well. Former President Trump, President-elect Trump, has obviously changed his tune when it comes to crypto. He's going to be very crypto friendly. I think the market is obviously taking its cue from that. Does it tell you anything but that it's just sort of a post-election trade, or is there something more going on in your opinion?
I don't think there's much more than that going on. What I would caution people on with this crypto trade is if it's really just going up because we think that the incoming administration is going to be crypto friendly, does that mean that it's been under pressure only because things haven't been crypto friendly? I don't think that that's the answer here. I think what's been happening to crypto is that it's had this really strong correlation with appetite for tech stocks. And you've got a lot of overlap between tech investors and crypto investors. And it had been a risk-on, risk-off trade. Now it's trading on something else. It's trading on perhaps lower regulations and maybe just more activity in the crypto market, more things, more fungible reasons to use it. But I don't think that it's something, especially when it goes up this quickly, I don't think it's something that's going to last all that long. Now, that doesn't mean that we have to have another crypto winter, but I think you have to be careful buying an asset based on policies that you think are coming in the next year or two, because we just don't know that yet.
Yeah, I mean, you talk about animal spirits. It's manifesting itself across a swath of the crypto world, and we'll see how long it lasts. You know, my concern is, this becomes a bit of a game of musical chairs. And when the music stops, I think people are going to be sort of looking at each other. So again, I'm not a crypto enthusiast. Many people have forgotten more than I will ever know. But, I also have seen things like this before. And, not to suggest this can't be significantly higher a year from now, but I think if there is a downdraft, I think it's going to be somewhat violent. With that said, I think some of it may take its cues off what we're going to hear this week in the form of consumer price index on Wednesday, Elizabeth, and PPI on Thursday, which is either going to basically give credence to what the Fed has been doing now for the last year and a half, or it's going to say, you know what, they have more work to do. I'm still of the belief that, prices are sticky. I think inflation, although not the problem that it was a couple of years ago, is still a problem. I also think it's going to be interesting to hear some of the commentary around these numbers, given what we heard from Jerome Powell last week, and given the fact that, he's steadfast in his belief that he's going to fill out his term. So this is one of the more interesting weeks on the inflation front, Liz.
Yeah, I tweeted right after that Fed presser that Powell said, "My name is no, my number is no." So he's not leaving as long as he can help it, at least not before his term is up. Just to prep everybody for what's coming on CPI. So year over year, the headline number expected to come in at 2.6% on Wednesday. That's 2 points above where it was last time. It came in at 2.4% last time. So that's not moving in the right direction, although nothing alarming if that is what happens. And then core CPI expected to stay steady at 3.3%. One of the things I want to point out, and I wrote this in my Fed note after the meeting on Thursday, is that Jerome Powell also pointed out they obviously track PCE. We all know that that's their preferred measure. But what we constantly look at is the 12-month number, the year-over-year number. If you look at it on a 3 or 6 month basis and annualize that, we're actually quite close to target. So that's why you keep hearing these messages from him that they are gaining confidence, that we're moving sustainably toward 2%, because they're actually looking at some measures that we don't really even talk about in the market. That's not to say that CPI doesn't matter. CPI matters for sentiment. I think CPI matters for what people are going to do with their spending, but it doesn't necessarily matter as much to the Fed. So I don't know that we're going to see a ton of movement. If things, let's say things come in bang on expectations on Wednesday in CPI, I don't know that we're going to see a ton of movement in rate cut expectations for this year because we're still more focused on that PCE data, as is Jerome Powell.
Danny, what is your sense here and what's going on the inflation front? But more importantly, this interest rate move, because we've talked about it. Elizabeth and I have talked about it. We've talked about it. Collectively, we've discussed it. The move since the middle of September, I think we almost got to 4.5% in the 10-year. I think we ticked up to 4.48, if I'm not mistaken. We've pulled back significantly. I think we're probably either side of 4.32-ish now. But with that said, it's been a pretty dramatic move higher in yields, which I think for a lot of people is counterintuitive. I think I have a handle on what's going on. I'm curious as to what you think.
So just to Liz's comments on no and no, I said on the tape on Thursday that he pulled the Wolf of Wall Street when he says I'm not leaving. But actually, I have a new term for it, and you can the Wolf of K Street. Right?
Oh, look at you.
Yeah, the Wolf of K Street.
For you playing the home game.
I just got that. That's it. That's done. No one can take that from me. So the Wolf of K Street. Liz, feel free to use that later. I'm sure you'll be on CNBC. You don't have to quote me. But listen, I think that the follow through in the markets late in the week after rates kind of spiked higher on the 10-year and pulled back in, when they started to pull back in the rates, I think it was a green signal for equities to feel like, okay, we're okay right now. I feel like towards the end of this year, I don't see a huge chance of rates on the longer end moving sustainably higher. If they do move sustainably higher from here, I think it's a result of people's concern that inflation policies, debt growing, deficit growing, that's going to be an issue. So I think we're kind of in this narrow band here. It's really hard to say because at some point, obviously, credit spreads are so tight, right? You need credit spreads to widen to really slow the economy down. So it's like the horse and the cart. I'm not sure which will happen first, but again, if treasuries rally and yields come in the long end, is it a flight to safety? Is it economic slowdown? What is it? Because I don't think it's policy. So again, I can't predict, but it is good to talk about because it is one of the most important inputs for so many different securities in the world, right? Where's a 10-year going to be? And I think that we're seeing wage expectations have gone back up again, I believe. Inflation expectations started to kind of stop going lower and creep higher, if I'm not mistaken. And that's what I think I would want to watch, is what the expectations for inflation are rather than the current readings that we're going to see now. I think that's more important.
Well, Elizabeth, this takes me to my next question. We're 20 minutes or so into this, and I have not mentioned small caps, but I'm going to do it now. And again, I'm not suggesting this is the best constructed ETF, but the one that everybody seems to look at is the IWM. And today, this Monday, as we're sitting here, the IWM, the Russell 2000 ETF, made a new 52-week high right around 242, which mirrors the same high that we saw this time of year in 2021. We've been talking about that, you and I, for a long, long time now, the need for the Russell, the small caps, to sort of take out that prior high. I think a lot of it is predicated on this hope of obviously renewed growth here in the United States, the fact that maybe the Fed has their back in terms of interest rates, although we had that conversation, and the hope that an underperforming asset group is going to start to catch up to everything else. So what is your sense here? What's going on? Is this finally what people have been waiting for in the lens of the small caps?
Well, I mean, I think it sniffed that prior high. So it has now happened. We had attempted it, I think I said 7 times in one of our last shows. So we're finally there. Now, one of the things I would say we had earlier in the year, earlier in 2024, this is the July-ish timeframe, we saw a period where small caps gapped higher, right? They went up very sharply. Everybody got excited. This was going to be the moment. And then they sort of sideways for a few days, and then they gapped lower, filled in that gap, and tried to find their way again. And then they sort of plodded along. So this was, again, a gap higher. I would caution people about that. Now, that's not me saying that this isn't the time when they're actually going to do it. I would just say in the very short term, always be mindful of that gap and careful about when something goes up that much. Is this the time when they're going to break out? It could be. It really could be. If they beat that prior high, you probably expect that there's another, let's say 5%, 10% after that, just based on pure momentum and based on money coming out of other assets and going into things as a chasing trade. And I think small caps will be one of the beneficiaries of that. If you want something a little bit safer, something a little bit more diversified so that you can sleep at night sort of allocation, you can look at something even like the equal weighted S&P, where you've got some exposure to smaller cap names, you're spreading out your exposure across sectors in a different way. You can also look at an asset class that would be called SMID cap, which is somewhere between small and mid cap. Usually the market cap of those companies somewhere between 2.5 billion and let's call it 5.5 or 6 billion. And they're a little bit safer. They've at least graduated out of that small cap, often non-profitable segment. So this is definitely something to watch. Last thing I'll say about this, in some of these smaller cap names, more so in mid cap, but some of these smaller cap names, you find a lot of financials in there. And obviously we know financials have been trading really well since Trump was reelected. So you're going to see a lot of correlation between small and mid cap names and what's happening in the financial sector.
Yeah, 2 seconds before we go to Danny, I'm looking at the KRE, and that is a regional bank ETF trading either side of $67. I think the 52-week high is effectively $67, but the all-time high, Danny, in the KRE was made in January of 2022. So you have a lot of things making an all-time high. I mean, this KRE is still probably, 18 to 20% off its prior high. But to Elizabeth's point, if you believe in the small caps, Danny, almost by definition, you have to believe, I think, in the small and regional banks. Thought on that?
Well, back to the small caps in general, I mean, I think it's pretty simple. More M&A, less regulatory oversight, which is not necessarily a great thing for small companies. You should be adhering to the correct laws of securities laws. And I'm not accusing anyone of doing anything wrong. I'm just saying in general, it's kind of a little bit of a Wild West mentality now. I think it's off to the races. As it relates to the banks, again, following on the M&A theme, obviously there, and potentially being able to raise capital for some of these smaller companies and being a player there. I think it's just buy now and ask questions later. And people were using these stocks, I think, as shorts versus maybe longs on some other things, maybe even the large cap banks. I know both have rallied here. There's so many names out there in sectors that were either under-owned, and when they start to move like this, fund managers have to chase, because if they're under-owned regional banks, they got to get to the benchmark. So they need to get there. So I think that's also what this is, as well as I think fund managers participating more.
So, I mean, obviously, a lot of what this is I think to your point, Danny, the lack, I shouldn't say the lack of regulation, but the less restrictive regulation clearly plays to the benefit of these banks. And I think the market is taking its cues from that, and obviously M&A as well. And, you're seeing it, quite frankly. I mean, if you look at some of these private equity names, for example, Carlyle Group, as we're sitting here, has been making a new multi-year high. Now, that's been an underperformer for quite some time, but there are other names as well, Blackstone. So the market is clearly excited about the potential for less overreach, I guess. With all that said, somebody that's not all that excited about what's going on, and I only say that through, again, the prism of what he's doing in terms of his cash position, Elizabeth, is Warren Buffett, whose now cash holdings at Berkshire Hathaway is a record $325 or so billion. We talk about the Buffett indicator all the time, and I want to say, for the 1,000th time, we are not suggesting you trade on indicators like that, but we'd be remiss if we didn't point out that that's now north of 202%. And his sort of threshold where he gets concerned historically is about 130% or so. So the Buffett indicator flashing red, Berkshire Hathaway raising cash. Thoughts on that?
One of Warren Buffett's most famous quotes is something along the lines of, "The market is a mechanism designed to transfer money from the impatient to the patient." And I don't know Warren Buffett personally. I don't talk to him on a regular basis, but he strikes me as a man who sticks to his knitting and he sticks to his principles. So if the Buffett indicator or something along that vein is one of his big principles, he's trading in line with what he has always believed. And he's put that pile of cash into treasury bills. Now, as rates have risen, that's probably an okay place to sit for a little while. The question that continues to come up, and I don't know how we would ever know the answer to this until it actually happens, is he stockpiling cash because he's on his way out? Or is he stockpiling cash because he's readying to buy something? Or is he stockpiling cash because he's nervous about something ominous to come? I don't think he's going to answer any of that directly, but that's going to be the speculation. That's what continues to be the big speculation. I think Berkshire Hathaway will do fine in either event, in any of those events. I think that he's set up a pretty good succession plan for himself. Now, will there be volatility if and when he does finally depart? Of course. But this question of, why is he keeping all of this cash around? Why has he built up more cash by selling some of the biggest positions that he has in equities? You have to assume that there's got to be some reason other than he's just preparing to depart.
And he could be returning capital in the form of a dividend at some point. And I would also note that he's not buying his own stock either. Mm-hmm. So
that's right.
Kind of all lines up. So he could return a dividend, but to Liz's point, he might be setting up to buy something. But again, I don't think he sees a lot of attractive investment ideas out there right now at these prices. Now, listen, we say that.
Go ahead, Jen.
Occidental's reporting this week, correct? I know we haven't talked about some of the. I'm not saying he's going to go out and buy more Occidental, but who knows if that thing were get to a level. Right, you could see him increasing his position in something like that you think has been left for dead, so to speak.
Well, it's interesting, quickly about Occidental. Elizabeth, you don't need to opine here, but I mean, since he announced the stake in this stock, and I think it was probably a couple years or so ago, I think he's amassed, I want to say now north of a 30% holding in the company. Don't at me if I'm off by 1% or 2%. But quite frankly, I mean, X a couple of moves to maybe 73 or so. This stock has not done a damn thing since his announcement. And his average price, not that it matters to him, is probably significantly higher than the current $51 that it's trading at, which is fascinating because historically, when he makes bets like this, the stock acts in kind, but that's neither here nor there. But Elizabeth brought up an interesting point, the reasons why. Liz, have you ever seen the movie, this is a bit of a rhetorical question, Godfather 2?
No.
Which is troubling for a myriad of different reasons. But there's a scene that Danny is familiar with, and hopefully at some point later today, Elizabeth, you will familiarize yourself with as well, when Michael Corleone is in Cuba sitting with Hyman Roth, and they're having a birthday party for him. And, Hyman is enjoying his birthday, but he's also opining that he probably doesn't have a lot of time left. But Michael knows that, Hyman Roth thinks he's going to last and live forever. He actually makes reference to that and the fact that he's been dying of the same heart attack for the last 20 years. I say that not to suggest that Warren Buffett thinks he's going to live forever. He doesn't. But my instincts suggest he does things today the same way he probably did it 15, 20, 30 or so years ago. I think he's just a bit of a rule follower, and I don't think really age comes into the equation. So as much as people want to say, he's doing it to set up the next person who's going to succeed him, I just think he's doing it because he's playing by the same set of rules, Danny, that he's played by his entire investing career.
Yeah, he's going to be opportunistic, and he's longer term. And if he misses a little bit run in the market, he's fine with that. And obviously, something like Occidental is only 50 billion market cap, and I don't know what the total enterprise value is, but he could put 10s and 20s and 30s to work potentially in ideas. So I just think he's waiting. And listen, he's getting paid to wait. T-bill yields are still decent, and so everyone's jealous of the arsenal that he's built there. So.
Somebody, by the way, that made a pretty big bet along the lines of Warren Buffett and Occidental Petroleum, Danny, is, like it or not, is Elon Musk. And I mention that because as we're sitting here today, Tesla is making a new 52-week high, a multi-year high. We're still nowhere near the prior all-time high that I think the stock traded to, I want to say, if I'm not mistaken, in November of 2021. But we're getting close. And, this has now gotten through the trillion market cap. He made that bet. The bet is paying off. I guess the question is in your opinion, how long does it last?
I said last week, and it's no longer trading on fundamentals. I've been got out of it when you realize that was the case, because how do you value something that, trades on non-fundamentals? He basically, as I've said this all along, he aligned himself with Trump, I believe, for one reason and one reason only, and that was to protect himself from all the agencies which have been coming after him. That includes the European agencies, using J.D. Vance now to threaten to pull out of NATO unless they leave Musk alone, all this stuff. Who does Musk endorse today for Senate Majority Leader? Rick Scott. Why would it be Rick Scott? Why does that benefit him? Because Rick Scott controls all the SpaceX launches in Florida, because remember, the state of Florida took over control from NASA, all these launches. So there's always a method to his madness and what he does. And listen, he took a gamble and it paid off. I just find it very ironic that he was built by environmentalists. His company was built with these tax credits, regulatory credits going on, and now he's flipped. And it's for himself and one reason only. But I do fear this guy coming in. Forget about the stock. Forget about Tesla stock. You should be very concerned as a citizen that the person that has committed securities fraud, the person who's been accused of various things, lawsuits everywhere, is now going to come in and give advice on certain agencies on how they should be run. That makes me nervous. And that's aside from the fact of my feelings about him or the company. So yes, congrats to him on a gamble that paid off, but I'm not buying in on his nonsense. So,
Elizabeth, before we get out of here, we do have a lot of Fed speak this week, and I think Jerome Powell on Thursday is actually speaking as well. Thoughts on the importance, if any, in terms of what we're going to hear? We're going to hear from Lori Logan this week. I think the St. Louis Fed president, Alberto Musalem, speaks. Jeff Schmid from Kansas City speaks. It's a typical week because they seem to talk over and over again. But I think it's a New York Fed week where John Williams is delivering the opening remarks.
I think that Powell's speech on Thursday will be the only one that really has potential to move markets, but largely because he has a chance to react to inflation numbers that came in the day before. So if he says anything that seemingly changes his tune from last week, that has the potential. Other than that, I don't think that this is really high risk for Fed speakers. I think right now, if last Thursday was any indication, the market isn't going to react much because we're expecting that the Fed sort of stays steady as she goes, at least through the end of the year. And right now, the expectations are for about 65 to 70% chance of another cut in December of 25 basis points, and then perhaps a pause in January. So I think it would take something pretty big to move those expectations materially, but we should listen to what Powell says on Thursday on CPI.
Please refer to Powell now as the Wolf of K Street. I would appreciate it if we would just keep using that. So I'm waiting to hear that on broadcast television.
I think Elizabeth will take that under advisement. A lot this week for sure. Things are going to start to get, I would imagine, as we approach Thanksgiving, start to thin out a little bit. But, there's still some things out there, I think, in terms of the market and geopolitically we have to pay attention to. But this was an excellent primer to the week. So Danny Moses, thank you as always. Elizabeth Young Thomas of SoFi, thank you. We'll see you later today for Market Call.